From the morning reading, the bulls continue to knock on the door of resistance. The good news is that the bulls are a very resilient bunch. The bad news is that time could be running out on a break of this downtrend. Money is shifting and not in a good way. First, it's clear that traders have a preference of late for the Dow Jones and the S&P 500 over the more aggressive NASDAQ and Russell 2000. Traders do not want risk after the FOMC announcement, and money has been rotating away from it ever since. We have seen money rotate back towards both the NASDAQ and the Russell 2000 in October, so that helps, but we still have a long way to go. Furthermore, 60-minute negative divergences are everywhere, and that indicates slowing upside momentum. We once again test key resistance levels. None of this guarantees that the market will head lower, but it does suggest risk is elevated. The S&P 500 is back in an intermediate term uptrend. At least that would be the contention of those using the 50-day average, which the S&P just rose above for the first time since mid-August. When it has crossed above the average after falling into a correction, buyers have tended to keep pushing it higher for at least the next month. Of the 26 precedents, 18 of them did not see a new low within 2 months, though some failed after 2 months went by. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:56 a.m. Central Time, and I'm recording this in preparation for the market day of October the 9th, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's take a look at what happened in the overnight. And on our morning report, everything looks to be just marginally above scratch. The S&P, Russell, and Dow, all at the time of this cut, were just barely above scratch. NASDAQ was just barely below scratch. So no significant bias coming in to the market at the time of this cut. Crude oil, though, clearly has a bias. It's up almost 2%. Euro up about 0.75%, bonds up about 0.25%, and then gold up about 0.8. So that's a little odd to have bonds and gold, though probably not too much to be made of bonds in that only 0.25%. But that gold would be up about 0.8% at the same time the broad market is slightly up. In terms of overseas action, China continues its strong ways, up 1.27%, Hong Kong up about 0.5%, Japan up about 1.64%, Germany up about 1 and almost 0.25%, United Kingdom up about 1%. In terms of macroeconomic reports for today, very light schedule. You do have an FOMC member speaking. You do have import prices coming out. So and then later today, FOMC member Evans speaking as well. So both Lockhart and Evans speaking today. So pretty light schedule, as is typical of a Friday. In terms of our volatility conditions, things continue to fall. You see short-term VIX down to a 15.47, and obviously this is getting back down to more normal levels that we associate with bull markets. We'll take a look at the VIX futures chart in just a second. Though, notice this one fly in the ointment, the skew, 136.7. That's very high, and that has its own warning potential there. We'll get more into that in just a second. IV percentiles all continue to be very low, 28, 18, 25, 21 across the 4 indices, so essentially all in the lower quartile. We did have a standard deviation move put in yesterday by the S&P and the Dow, and you remember from the morning reading we mentioned about how while market has been coming in a bullish way, it's been going into very, very kind of defensive places, and you know, big caps, and as in the Dow, and kind of big caps as in dividend stocks and so forth, not so much into NASDAQ and Russell, though they have improved. And we'll take a quick look here at the charts. SPX, you see here, we have clearly broken through that first line in the sand that we've been talking about. We still have not cleared the second one, which is the FOMC tick high. And you notice that we had that big spike that 1 hour after the FOMC announcement, which was then subjected to being rejected by the bears. And we haven't cleared that yet, and I think that would be of some minor resistance. So certainly keep an eye on that. More important will be this 2040-ish area, which is the lower side of the prior range. So again, we continue to see significant areas of resistance that are in confluence and near proximity between this area of 1995 and this 2040 area. A lot of resistance in this zone. Obviously yesterday we had the 50-day moving average that also cut through this zone. So there's even other resistances that I've not been talking about. But bottom line is there's quite an area of resistance. Yesterday's action, again, with the stimuli of the Fed minutes, needed some additional stimuli to kind of push up through some of that resistance, but that did happen, and we did have a pretty significant move. And if you'll notice on the 5-minute chart, when did this action start? It started at 1 o'clock. Prior to 1 o'clock, really had done nothing, but then once that Fed minutes became clear, we went from that 1996 resistance area up 20 points and closed near the highs of the day. So obviously it was all about those Fed minutes. We wondered if they would have much impact, given that we pretty much thought we knew everything already. But clearly there were traders who thought that that was important, and it was important to the price action because it went up 20 points from that announcement. In the Russell, as we said, we need the Russell to be the strong one, not the laggard. And you see it's not even gotten back up to this former swing high area yet. Forget about the Fed minute spike. So while significant in this bullish action, it's less relatively strong, and that's an important distinction here because we need companies like those small cap growth oriented companies in the Russell to be the leaders in a true bull market. And then there's the NASDAQ also lagging while somewhat bullish, and indeed, I mean, you could call this indecision, but then bullishness. It was able to kind of pop and close up above this most recent action, but it still has not even reobtained the prior swing high, and certainly is long behind the SPX in coming and challenging this FOMC wick. So the two indices which are usually responsible for driving bullish growth are both lagging, and that's very much what those morning reading headlines was going at. Whereas you see the Dow, those big caps, largely defensive, dividend paying, slow, sluggish kinds of companies. Well, look at this. So, it's actually broken above that second line of resistance, above that FOMC wick, and closed clearly above that, and is on the verge of coming back into the former range. I mean, that's really the last line in the sand before it kind of heals the technical damage from the August drop and resumes its former range zone. Now where it goes from there we'll have to wait and see, but it clearly is the strongest one of all four of the broad market indices, which is not saying a lot for the bulls. In terms of the VIX, also important action here. You see it clearly broke below this 20 area and even broke down below what might be seen as the support region around 1819 kind of thing. So we had a close yesterday at an 18.4, and the action so far today continues to be drop in volatility. So this is a good sign for the bulls. If we start to fall into this, 12 to 18 region of volatility, that's the land of bullish markets and bull market volatility. So this is clearly heading that way. It clearly has confirmed that entry into this lower zone and broken down from here. And yet at the same time, we have to wait to see if we get a head fake and just peekaboo down below this zone and then right back into it. That could also happen. So we'd like to see a little bit more confirmation, but it certainly has the early confirmation and is well on its way to doing good things. In terms of our regular daily report, we continue to be in transition here. IBD status is positive with a confirmed uptrend. Accumulation distribution is also positive at a B minus, though the NASDAQ continues to be at an E. Again, that differential we've been talking about how the NASDAQ and the Russell continue to lag, and you see how this scoring on accumulation distribution seems to show that NASDAQ is not contributing very well. GMI index did improve a notch to a 3 out of 6, though it's still on a sell signal, and that author's still in cash. Primary market condition, let's see here. Actually, if we closed above the 50, we probably are neutral bear. So a slight improvement there. I need to double check those numbers. No change in the decision points status. Still have green arrows on short term, but largely down arrows, red arrows on the intermediate and long term. Intermediate term market posture, solid bullish. So consensus here is probably still land of transition, but clearly the bulls continue to build strength, and that continues to be reflected more and more across these mechanical signals. In terms of position sizing, still calling for up to 100% in the investor position sizing, and then in the active trader based on volatility, that is still calling for up to 75%, though it's starting to get close to where that would also go to 100%. That intermediate term market posture is clearly bullish at this point. The S&P's at a 72.8. This has really healed very nicely in recent days. A lot of the technical damage that was done back in mid-August has been alleviated, though not totally cleared, but much of it has healed. And indeed, if this were to pop to an 80, it would go into a very bullish condition, as is the Dow already. We continue to be concerned that the NASDAQ and Russell lag, and you can see even on the scores here, the NASDAQ well behind the other two, S&P and Dow, and then of course the Russell behind everybody at a 54, but it has now obtained a bullish rating. So all four are at least bullish, with the Dow at very bullish, so that's of significance. Our hedge warning status remains a level 1, and this is mostly a reflection that we have this problems with these signals, though you could certainly make an argument if we continue a couple more days, that we could take this down to a 0 plus, another half notch down. Volatility based metrics, you see it's almost all black and good shape. You got the VIX futures still up over 18, but only by a little bit. And you have this little warning, the skew up above a 135. There's an 11.75% probability of a 2 standard deviation move within the next 30 days. So that certainly is a warning sign out there, but it's one of really just a few warning signs left. New York Stock Exchange new highs, new lows, very, very good readings yesterday. 651 new highs against only 23 new lows. On the intermarket risk aversion indicators, only you have 2 now as risk on, 3 risk off, so that continues to be a little bit of a warning sign. Option income strategies, VIX is outside the acceptable window for novice trader. Aggressive traders can leverage higher premiums, but consider reduced position size and potential for higher than normal delta and vega moves. This position opinion could be altered here soon, in that if that VIX drops below and 18, this would be the inside the window for all levels of traders. So kind of consider that. Cover call strategies and put selling both are in good shape. Absolutely bullish conditions at this point. Acceptable to initiate new positions in both. Novice traders consider 1-for-1 ratio in the money, out of the money strikes and covered calls. Consider reduced position size or legging in through out of the money put selling. We still are somewhat defensive, especially since the market seems to be so defensive in where the money is rotating to. So while we continue to feel more comfort about edging into more positions on a bullish standpoint, you should recognize that most of these positions that people have been going into have been done with very defensive kinds of posture. So probably need to mirror that posture and not get out in front of this wave. You want to ride the wave. You want to ride the wave all the way to the beach. And yet at the same time, if you get out in front of the wave, you'll have no energy and you will come to a standstill. So be careful that you're mirroring what the market is telling you, and also read the tea leaves in terms of just how defensive these positions are, and be taking a similar approach. In terms of sector specific, really continues to heal again, short and intermediate, almost all green across all sectors. Only healthcare is lagging. Healthcare, of course, has been hit with the Hillary tweet impact on the biologics, and that IBB ETF, etc., has taken a pretty significant hit. Though I frankly think that the bottom on that will come at some point. The fundamentals of those companies have not changed, and while they are certainly taking a bit of a hit from the political scene, and some forces wishing to, and California is also talking about capping drug prices, so there's going to be continued pressure. It is a high beta area if you're talking about those that IBB type of sector. And many of the places that have improved the most in healthcare of late have been the more defensive parts of the healthcare sector, not the high beta areas. But this may be something of an opportunity, so keep an eye on that, looking for entry signals, perhaps scale in, use defined risk. In terms of percent change, big day yesterday. Energy at the top, industrials, materials. So that complex continues to shine in recent days. You look at utilities, again, that defensive one, not only added, but look at the consistency, 5-day, 1 month, 3 month. It is really starting to kind of put together, a pretty consistent story, but again, defensive in nature. And healthcare just barely positive in relation to the others. That should be enough for today. Oh, I had one other thing I wanted to show you. We hear sometimes people talking about, well, the market's so overpriced, and they're usually referring to this PE ratio. I thought this graph was of some interest in that if you actually look at the 25-year average, and not necessarily an average based on decades, but more recent history, and 25 years is certainly still a significant time frame, but yet more focused on more recent market norms. But a 25-year history is a 25.60. We are right in that area. So while you could argue that we're kind of in the upper range outside of the dot-com bubble, that would be true, but certainly these PE ratios are not of the kinds of levels that have caused a lot of problem in the most recent decades. So make of that what you will, but I did think that of some interest. In terms of how you express appreciation, if indeed you feel like this has been helpful to you in your trading and your knowledge of the markets as you get ready for the day, that appreciation is done by hitting that button to retweet us to your Twitter followers, to your StockTwit followers, Scootify, we're there. Facebook, we're there. Like us on YouTube, subscribe to our YouTube channel. If you do that, you'll get quick notification about when the YouTube video goes up in the morning. Obviously, we continue to share those hyperlinks across the platforms as that happens, but we greatly appreciate your acknowledgement of our work through this affirmation process here. Then if you have more questions about what we're doing, certainly if you can go to this website and you'll find out how we actually leverage these principles into our own trading. More information is available there. It's a very modest membership, only $50 a month, to have access to all the benefits of the live chat room, as well as to all the various subscription products that we provide, which are certainly significant. Free trial is available. Disclaimers as always. Hit the pause button if you need more time to review this. And we greatly appreciate you each and every trading day at the Falcon Global Trading Community. And the market preview will be back on Monday morning before the market open.